On the surface, Block looks like your standard fintech company. CashApp has a clean, simple interface that feels intentionally anti-bank, fast, minimal, and confident. Square, Block's original product, is designed to feel more grown-up, a dependable tool that will be there when you need it. Modern but restrained, optimized for reliability over personality. Together, the aesthetics suggest a familiar fintech story: slick consumer design on one side, professional payments infrastructure on the other. But the polished fintech exterior masks a business far more exposed to credit risk than most people realize. A structure that feels durable on the surface, yet is far more fragile than it appears. By the end of this video, you'll understand exactly how Block makes money, and why a single fracture in that system could ripple through the business far faster than most people expect. To understand where that vulnerability comes from, we have to go back to what this company was originally built to do. Block began as a company called Square, named after its first product. Square's original goal was to make it easy for any small business to accept credit cards. Its compact card reader turned any smartphone into a checkout counter, letting independent sellers and local shops take payments without expensive hardware or bank contracts. As those small businesses grew, Square grew alongside them. What started as a credit card reader became a full suite of business tools: point-of-sale systems, inventory and reporting software, payroll management, and even small business loans. Over time, Square became a dependable operating system for millions of merchants. Today, that merchant business is large, profitable, and steady. It generates about $4 billion in gross profit each year and grows at a measured pace. This part of the company is the foundation: predictable, durable, and tied to the day-to-day activity of real businesses. But in 2021, the company changed its name from Square to Block to signal a broader ambition. It was no longer just building tools for businesses to accept money. It was trying to build an ecosystem around how money moves. That shift in focus changed the company's center of gravity. The fastest growing and most important product inside Block is no longer the merchant tools that made Square famous. That product is CashApp. CashApp is designed to be more than a payments app. It's built to become the place where a user's money lives. It all starts with deposits. CashApp makes it easy to have a paycheck sent directly into the app. When income lands there first, Block can see not just how much someone earns, but when they get paid and how much their balance changes over time. That position is powerful. Because deposits and spending both happen inside CashApp, Block has real-time visibility into a user's cash flow. This lets Block do something unusual for a consumer app: make small, short-term loans that are closely tied to a user's real cash flow. Instead of relying mainly on traditional credit scores, they can base lending decisions on observed income and spending patterns inside the app. And because future paychecks and balances also pass through the app, Block has a strong, built-in path to repayment when new money arrives. Most everyday actions inside CashApp are free. Users can receive deposits, hold a balance, and move money around, albeit with a small delay. Block makes money when users need speed, credit, or when they want to trade. When a user makes a purchase with a CashApp debit card, the merchant pays a processing fee. A portion of that fee then flows back to Block. If a user wants to move money out instantly instead of waiting a few business days, they pay an instant transfer fee. If they borrow against their next paycheck, they pay a fee on that loan. If they split a purchase into installments, Block earns money from that transaction as well. And when users buy or sell Bitcoin inside the app, Block earns a fee and captures a small spread on the trade. Individually, each action generates only a small amount of revenue, but together, across tens of millions of active users repeating these behaviors every month, they compound into billions of dollars of annual gross profit. Features like peer-to-peer transfers, saving, and investing help keep money circulating inside CashApp. That continuous flow of deposits and spending is what gives Block the visibility and repayment priority that make the lending and fee model work. The engine is simple: get the paycheck first, observe the cash flow, advance small amounts against the next paycheck, and charge for speed, credit, and trading along the way. Block isn't just CashApp and Square though. It also owns Tidal, a music streaming service, and is building several Bitcoin-focused businesses, from self-custody hardware wallets to mining equipment. These efforts point in very different directions and serve very different communities. They show a company experimenting at the edges of finance, media, and open source infrastructure. But economically, they are not independent pillars holding the company up. Most of Block's incremental profit still flows through the CashApp engine we just spoke about. That creates an unusual situation. The company looks diversified on the surface, but a large share of its profitability is tied to one system built around small, short-term consumer credit. This is where the fragility comes in. For a typical payments or software company, credit losses are a rounding error. For Block, they are a major operating expense and a key driver of both profit and risk. In good times, when paychecks arrive predictably and users repay on schedule, that credit engine hums along and adds meaningful profit. But in a recession, this expense can spike at exactly the moment revenue growth slows. Even a small increase in missed payments can have an outsized effect on their earnings. Block isn't new to lending. Through Square, it has years of experience advancing funds to small businesses and getting repaid from their future sales. That history likely improves their underwriting discipline. But CashApp borrowers are different from Square's merchants. Small businesses repay out of business revenue. CashApp users repay out of personal paychecks. That makes the system more exposed to employment, income volatility, and consumer stress. And all of it depends on one quiet assumption, that paychecks keep landing in CashApp first. If a bank or competing wallet convinces users to send their income somewhere else before it reaches CashApp, Block loses its first look at those cash flows and its easiest path to repayment. The lending model still exists, but it becomes riskier and less predictable. None of this means the company is on the brink of collapse, but it does mean Block is more leveraged to consumer credit performance than most people realize. The same mechanism that makes CashApp powerful in stable conditions also makes it unusually sensitive when those conditions change. Block isn't just a payments company, a banking app, or a collection of side bets in music and Bitcoin. It's a system built to sit in the middle of how money moves between businesses and people. Square anchors the merchant side, CashApp anchors the consumer side. Together, they let Block see and participate in both ends of everyday cash flow, where money is earned, where it's spent, and where it needs to be advanced or accelerated. That positioning is why the company can generate billions of dollars in gross profit from small, repeat actions like card swipes, instant transfers, short-term loans, and installment payments. But it also means a meaningful share of that profit depends on consumer credit performing well, and paychecks continuing to flow through Block's rails first. For most fintech or software companies, credit losses are an afterthought. For Block, they are the central variable. The result is a business that is both sturdier and more sensitive than it first appears. Sturdier because it sits at the heart of everyday transactions between merchants and consumers, and more sensitive because it relies on advancing money today based on the expectation that the next paycheck will arrive on schedule. Block works best when it is first in line when money arrives, not because any one product dominates, but because the entire system is built to capture, observe, and move cash the moment it shows up. Thank you for watching.